most people, imagine money as something solid and simple. Coins, banknotes, maybe gold in the past, and now just numbers on a screen. But in reality, most of the money people deal with today is not normal money in the old physical sense. Most of it is bank-created balance money. The number you see in a bank account, on an exchange, in a payment app, in company balances and store prices, and even in many investment accounts is usually part of a much larger credit structure. Modern central banks and monetary authorities explain that most money in circulation exists as bank deposits, and those deposits are largely created when commercial banks issue loans. That means a big share of the money people use every day started as debt. A bank gives a loan, and at the same time it creates a deposit in someone's account. From there, that deposit moves through the economy: salaries, purchases, rent, taxes, contractor payments, online transfers, asset prices, exchange balances. So when people say, "I have money in my account," in many cases, they really mean they hold a claim inside a credit-based system. It works, it is accepted, and it functions as money, but it is still deeply tied to lending and debt expansion.
By contrast, normal money in the simple sense, banknotes and coins plus central bank-based money behind the system, is different. A banknote is not created the same way as a private bank deposit created through lending. Physical cash is limited, direct, and not multiplied across the economy in the same way as layers of bank credit. That is why many people instinctively trust cash more. It is simpler. It does not depend on a chain of borrowers continuing to roll debt, refinance debt, and service debt at scale. In that sense, normal money is often perceived as more stable and more real, while balance money is more elastic, more expandable, and more vulnerable to booms and contractions. Even salaries are heavily tied to this credit circulation. A company pays wages from revenue, but that revenue itself often comes through a chain of loans, overdrafts, mortgages, consumer credit, business credit lines, government borrowing, and financial leverage. A lot of the money passing through payroll systems is not some isolated pile of old saved cash. It is part of a moving stream of deposit money, and deposit money in modern economies is mostly created and sustained by lending. So people can work for money, earn money, save money, and still be operating mainly inside a debt-made monetary flow.
This matters. This matters because when credit expands too fast, the economy can look stronger than it really is. Asset prices rise, spending rises, businesses overextend, households borrow more, and everyone starts treating temporary expansion like permanent prosperity. Then the cycle turns. The year 1929 became the most famous example of what happens when leverage, speculation, and financial fragility collide with collapsing confidence. The Great Depression that followed was not just a stock crash story. It was also a collapse in credit, demand, banking stability, and money circulation through the wider economy. The inflation waves of the late 1970s and early 1980s showed another side of the same problem. When money and credit conditions become too loose for too long, prices can spiral upward, and restoring stability can require painful tightening. Federal Reserve history materials note that inflation in that era rose from low single digits to above 14% before aggressive tightening pushed the economy into recession, but eventually broke the inflation regime. This is one of the classic reminders that credit-based money is powerful, but not harmless. It can boost growth, but it can also destroy price stability when expansion outruns the real economy. Then came 2008. That crisis made it obvious to millions of people that balances are not all equal. Housing loans were stacked on top of securitization, leverage, derivatives, and confidence that prices would keep rising. When the structure cracked, the issue was not that society ran out of paper banknotes. The issue was that a huge mountain of credit money became unstable. Liquidity froze, trust disappeared, and governments and central banks had to step in massively to prevent a larger collapse of the financial system. 2008 was a lesson in what happens when too much of the system rests on debt expansion that looks safe until it suddenly does not.
Because the 2020s brought a different version of the same story. Not the virus itself, but the monetary and credit response after 2020 helped create a new inflation cycle. Central banks, states, and banking systems supported economies with huge liquidity, fiscal transfers, and easy financial conditions. Later, many official and central bank analyses described post-pandemic inflation as driven by a mix of supply shocks and unusually strong demand, with demand supported by financial stimulus, accumulated savings, and easy money conditions. In plain words, too much spendable balance money was chasing too few goods at the wrong time. So the key idea is simple. Modern economies do not run mainly on normal money as people imagine it. They run on layered credit money. The number in your account may function like money, and legally it is used like money. But economically it exists inside a lending system. That system can accelerate trade, business, construction, and growth. But it also creates fragility. When lending grows too quickly, prices can rise too fast. When lending contracts, entire sectors can freeze. And because most balances are tied to the system, ordinary people feel the consequences even if they never took a major loan themselves. That is why physical money and base money still matter as the foundation. They are the anchor under a much larger pyramid of credit balances. The modern economy needs credit to function at scale, but credit money should not be confused with something timeless and fully solid. It is expandable, reversible, and dependent on confidence. Normal money is simpler. Credit money is larger. And most of modern life, wages, prices, exchange balances, and savings numbers, moves through that larger, less stable layer.